Let's get right to it. Victoria's Secret, ticker VSCO, is no ordinary mall brand. It's a cultural icon fighting for survival as a standalone public company. Since its 2021 spin-off from L Brands, the stock's been a battleground. The big question, is there real money to be made here, or is this a value trap? We're not talking nostalgia, we're talking dollars and cents. We'll break down the stock's performance, strengths, and the risks that keep investors up at night. Victoria's Secret is in the middle of a high-stakes reinvention, trying to shed its outdated image and win over a new generation. If they nail the turnaround, the upside could be huge. If not, the downside is just as real. We'll dig into the numbers, the competition, and the long-term vision. By the end, you'll have the tools to decide, is this a comeback story or a cautionary tale? I'm not here to tell you what to do, just to help you become a smarter investor. Let's get to work. When VSCO hit the market in August 2021, it soared from $50 to the high $70 SS. Investors were betting on a classic turnaround. But the honeymoon ended fast. Today, June 2025, the stock trades around $18. If you put $1,000 in at the start, you'd have just $360 left, a brutal 64% loss. Meanwhile, the S&P 500 would have turned that same $1,000 into $1,250, a 25% gain. That's massive underperformance and a flashing red light for investors. VSCO's story is a value trap. Big brand, cheap stock, but no real growth. Quarter after quarter, the company failed to deliver. The stock's slide isn't just a dip, it's a sign Wall Street has lost faith. This is what happens when a famous name can't back up the hype. The lesson? Brand power alone doesn't guarantee returns. Hold on tight, this ride's been rough. The chart looks ugly, but let's dig deeper. Pro's Victoria's Secret still dominates the US lingerie market. The brand is iconic, with a loyal customer base and real profits, over $6 billion in 2024 revenue and positive net income. That cash flow gives them options: invest, pay down debt, or buy back shares. But the cons are glaring. Sales are shrinking, and in retail that's deadly. Competition is fierce, from online upstarts to big box giants. Cybersecurity is a real risk. One breach could destroy trust. Debt is another drag, about $1 billion, which limits flexibility. Wall Street analysts are lukewarm, mostly rating it a hold. The turnaround isn't connecting with consumers yet. The bottom line, Victoria's Secret has strengths, but the challenges are real and urgent. This is a company at a crossroads. The next moves will decide its fate, no sugarcoating it. To understand VS&Co, you have to look at the competition. Lululemon is a growth machine, premium brand, cult following, and explosive sales. It's innovating, expanding, and has almost no debt. Abercrombie & Fitch was once left for dead, but pulled off a stunning turnaround by embracing inclusivity and modern style. Its stock is up over 1,000% in 5 years. Both show what's possible with vision and flawless execution. VS&Co, meanwhile, is stuck defending its turf, struggling to find its new identity. Its massive store footprint could be a liability if those stores underperform. A&F proved a legacy brand can reinvent itself, if leadership is bold and the strategy is clear. Right now, VS&Co is still searching for its voice. The comparison is both a warning and a source of hope. The bar for a successful turnaround is sky high. Can Victoria's Secret pull it off? That's the billion-dollar question. The clock is ticking. Let's talk numbers, because numbers don't lie. 2024 revenue, $6.2 billion, but down 3% from last year. In a world of rising prices, falling sales is a red flag. Gross margin is solid at 34 to 35%, but operating margin is razor thin, just 4 to 5%. That leaves little room for error. A small sales dip or cost spike could wipe out profits. Scanda expenses are massive, over $2 billion. Cutting costs is tricky, cut too much and sales or customer experience suffer. Debt is a $1 billion anchor, especially with higher interest rates. Unlike Lululemon, which has a pristine balance sheet, VSCO's debt limits its ability to invest in growth. The company isn't in immediate danger, but financial flexibility is tight. Managing costs while funding a turnaround is a huge challenge. The numbers show a company with potential, but also with serious headwinds. Investors need to watch every quarter. The margin for error is slim. Booyah. Let's look ahead. By 2030, success means VSCO is seen as modern and inclusive, with e-commerce making up half of sales and modest growth returning. By 2040, malls may be history. VSCO must be a global, digital-first brand, with fewer stores and a focus on sustainability and tech. International expansion, especially in Asia and Latin America, is key. By 2050, survival means radical reinvention. Maybe as a wellness or tech platform, not just a lingerie brand. The only way to thrive: adapt constantly, embrace new tech, and lead in sustainability. The company of 2050 will look nothing like today's. The risks are huge, but so is the potential reward for long-term shareholders. The future belongs to brands that evolve or disappear. Visionary leadership is non-negotiable. The journey will be full of challenges. Only the bold will survive. The next decades will separate the legends from the lost. Here's the big question. Could VSCO ever hit $1,000 a share? Right now, it's pure fantasy. With 77 million shares, that would mean a $77 billion market cap, bigger than Lululemon or Ford. To justify that, VSCO would need $4 billion in annual profit, 16 times today's level. That's not just growth, it's a revolution. It would take a game-changing tech breakthrough, global dominance, and Apple-level brand loyalty. Maybe a world where VSCO licenses revolutionary AI fit tech to every retailer on Earth. Even then, it would need massive buybacks and a business transformation. The odds? Astronomical. Fun to dream, but don't bet your retirement on it. Reality check. Focus on what's possible, not just what's imaginable. So what's the call? The bull case. Iconic brand, big market share, and real profits. If management pulls off a turnaround, the stock could double or triple. The bear case: shrinking sales, thin margins, heavy debt, and a brand still searching for relevance. This is a high-risk, high-reward turnaround play, not a safe bet. I'm not pounding the table to buy, but I'm not screaming sell either. If you're in, watch every quarter and stay nimble. This is a show-me story. VSCO has to prove it can change. Your decision depends on your risk tolerance and belief in the turnaround. Are you a gambler or a conservative investor? There's no single right answer. My job is to give you the facts and the framework. Now it's your move. Booyah.